Warren Buffett has very aptly said that the more you learn, the more you'll earn. And Benjamin Franklin concurs. An investment in knowledge pays the best interest. Now we come to the crux of today's presentation. That is, how do I generate new ideas? The stock of CG Power has given more than 1700% returns already. And what was the stock price of Harita Seating? 534, which meant that you would make almost 40% returns in a few months' time just for patiently holding on to your stock and doing nothing else. Now, I ask all the viewers to simply go and check the stock prices of these four companies to see if there is any merger arbitrage opportunity. The best investment you can make is an investment in yourself. So keep learning, keep growing.
హలో ఫ్రెండ్స్, వెల్కమ్ టు మనీ పర్స్. లెట్స్ లెర్న్ సంథింగ్ న్యూ టుడే. ఈ వీడియో ట్రైలర్లో చూసారు కదా, మీ ఇన్వెస్టింగ్ జర్నీలో వన్ ఆఫ్ ది బెస్ట్ అల్టిమేట్ గైడ్ అయితే ఉన్నది. ఈ వీడియోలో మనం ది జాయ్స్ ఆఫ్ కాంపౌండింగ్ బుక్ ఆథర్ అయిన గౌతమ్ బేద్ గారిని తీసుకొచ్చి ఇంటర్వ్యూ చేసాం. ఆయన ఈ వీడియోలో చాలా మంచి ఇంట్రెస్టింగ్ స్ట్రాటజీస్, ఆయనకి హెల్ప్ఫుల్ అయిన ఆయన ఇన్వెస్టింగ్ జర్నీలో యాజ్ ఏ ఫండ్ మేనేజర్ కింద ఎదగడానికి హెల్ప్ఫుల్ అయిన వేరియస్ ఇన్వెస్టింగ్ స్ట్రాటజీస్, ఆయన పర్సనలీ ఇంప్లిమెంట్ చేసే చాలా ఇన్వెస్టింగ్ స్ట్రాటజీస్ గురించి అయితే షేర్ చేశారు. ఐఎమ్ షూర్ ఎవరైతే ఫోకస్ చేసి ఈ వీడియోని చివరి వరకు వింటారో మీ ఎంటైర్ ఇన్వెస్టింగ్ జర్నీలోని వేరియస్ పార్ట్స్లో ఆయన షేర్ చేసిన ఇన్ఫర్మేషన్ మీకైతే చాలా చాలా హెల్ప్ఫుల్ అవుతుంది. వన్ ఆఫ్ ది బెస్ట్ ఇంటర్వ్యూస్ యాక్చువల్ నేను చేసిన, ఎస్పెషలీ ఇన్వెస్టింగ్ గైడ్ కింద ఉపయోగపడే వీడియోస్ ఏవైతే ఉంటే వాటిలో నేను చేసిన ఇంటర్వ్యూస్లోని ఇంటర్వ్యూ కంప్లీట్ అయిపోయింది కాబట్టి కాన్ఫిడెంట్గా చెప్పగలను వన్ ఆఫ్ ది బెస్ట్ కంటెంట్ ఇది. సో ఫోకస్ చేసి వినడానికి ప్రయత్నించండి. యూ విల్ హ్యావ్ లాట్ ఆఫ్ థింగ్స్ టు టేక్ బ్యాక్. అండ్ అలాగే ఇలాంటి ఎక్స్పర్ట్స్ని మన ఛానల్ వరకు తీసుకొచ్చి ఏదైతే మీకు కంటెంట్ షేర్ చేయడానికి ప్రయత్నిస్తాం, ఎఫర్ట్ మీకు వీడియో చూసిన ఏ పాయింట్ ఆఫ్ టైంలో అయినా హెల్ప్ఫుల్ అయింది అనిపిస్తే వీడియో చూసిన ప్రతి ఒక్కళ్ళు వీడియోని లైక్ చేయడానికి ప్రయత్నించండి. చాలామందికి వీడియో నచ్చుతుంది బట్ లైక్ చేయడం మర్చిపోతుంటారు. తప్పకుండా లైక్ చేయడానికి ప్రయత్నించండి. అండ్ ఈ వీడియో మొత్తం చూసిన తర్వాత మీ ఫ్రెండ్స్ అండ్ ఫ్యామిలీ మెంబర్స్కి వీడియోని తప్పకుండా షేర్ చేయడానికి ప్రయత్నించండి. అండ్ ఈ ఇంటర్వ్యూలోని గౌతమ్ బేద్ గారు వేరియస్ బుక్స్ గురించి అండ్ అలాగే ఆయన స్మాల్ కేసెస్ గురించి అండ్ వేరియస్ అదర్ థింగ్స్ గురించి ఆయన ఏవైతే మాట్లాడారో దానికి మీకు కావాల్సిన, మీకు ఏవైతే లింక్స్ రిక్వైర్మెంట్ ఉంటుందో అలాంటి లింక్స్ అన్నిటిని నేను కింద కామెంట్ సెక్షన్లో ఫస్ట్ కామెంట్లోని అండ్ అలాగే డిస్క్రిప్షన్లో కూడా ఉంచుతాను. సో మీరు ఆ లింక్స్ని కూడా రిఫర్ చేయొచ్చు. సో ఇంకా ఫర్దర్ టైం వేస్ట్ చేయకుండా గౌతమ్ బేద్ గారిని ఇంట్రడ్యూస్ చేసేస్తాను మీకు. Hi, Mr. Gautam. Welcome to Money Purse. We have 7 lakh plus followers who are keen learners of equity market. I'm sure today the insights which you are going to share, they'll have a lot of learning for sure. Once again, thanks a lot for giving us this opportunity.
Thank you, Sai, for having me on this platform. And let me congratulate the team of Money Purse for doing a great job of empowering the retail investor community in India. I believe your videos are very educational and very informative, and they are of great help to the investing community. So thank you for the service that you are carrying out for the investing community in India.
Thank you. Shall we start the presentation?
Sure. Let me just share my screen. All right. So hello, everyone. Today I'll be talking about the discipline of investing. A standard disclaimer to begin. This presentation is solely for information and knowledge sharing purposes, and the stock examples shown are for understanding concepts and should not be considered as stock recommendations. Stellar Wealth Partners is a SEBI registered research analyst firm. We may hold some or all of the discussed stocks from this presentation in our proprietary accounts or small case model portfolios. It is also possible that we may have exited or may exit from these stocks in future without prior notification. Please do your own research and due diligence for any investment actions and consult a registered financial advisor for the same. And the views expressed are my own personal views and do not represent the views of any entity or organization. This is the statutory disclosure as per the SEBI research analyst regulations. The primary or the most important disclosure here is the first one. The research entity, that is Stellar Wealth Partners and its associates, employees, may own or may have owned in the past some of the stocks discussed in this presentation. So please do your own due diligence. This will be the flow of today's presentation. I'll be discussing my personal investing framework and demonstrate the same with the help of multiple case studies from the Indian stock market. And I'll conclude with how value investing resembles a life discipline. All the great investors in the world have one common attribute. They all have a clearly defined investment philosophy. And their investment philosophy is in turn shaped by their personal experiences, vicarious learning from other people, through books. In my case, these are the books that have defined my investment philosophy. Terry Smith's Investing for Growth taught me how to invest in high quality businesses for the long term. Capital Returns, edited by Edward Chancellor, taught me the capital cycle theory of investing in commodity and cyclical businesses. And Joel Greenblatt's classic book, You Can Be a Stock Market Genius, taught me how to invest in various special situations like demergers, reverse mergers, and other special situations. We'll discuss them in the presentation today. This is a brief snapshot of my personal investment process flow. At any particular point of time, I have an active watch list of companies and names that which I'm actively monitoring. And to that existing watch list, new ideas get added from time to time through my idea generation process. Finally, I come to a final active watch list of 10 to 15 high potential opportunities. That in turn feeds into my portfolio construction and portfolio tracking and rebalancing process. So let me talk about the construction, tracking, and rebalancing piece first. The portfolio on an average comprises of 20 to 30 names. Now, if you're thinking the rationale for this broad range of 20 to 30, it's because during a broad-based earnings-led bull market, when earnings growth expands across sectors, you have more opportunities, and that's why you'll see most investors' portfolios tend to become more diversified and a larger number of holdings in a bull market. But in a bear market, as earnings growth dries up, you end up with a more concentrated portfolio because you have less number of investable opportunities. The aim is to generate 20 to 25% CAGR for the portfolio over a minimum holding period of 3+ years at any point of time. And I follow a sector and market cap agnostic investing approach with a bias towards under-researched and well-run small to mid-cap companies. There is no hard cap, there is no formal cap on the contribution to the portfolio from any one single idea or sector or market cap range, but prudence is always maintained at all times. The weight per stock ranges from 3 to 5% at cost, and the exceptional opportunities may get an allocation of even up to 10% in the very beginning. The decision to exit any investment will be solely based on their business performance or their potential incremental IRR. And a portion of the portfolio is kept in cash if the valuations of the existing holdings and the watch list become exorbitant. Coming to portfolio tracking, I track the industry trends of my portfolio companies like changes in competitive landscape, technology, regulatory changes, supply chain disruptions. The quarterly results are evaluated against my own expectation, and the performance is benchmarked against that of competitors. A detailed diligence is carried out in case any investment's performance is not as per the initial investment hypothesis. Finally, we come to the portfolio rebalancing piece. An investment is sold if either its valuations become absurdly expensive or if there is a structural challenge to its business fundamentals. The portfolio companies are periodically ranked based on valuations, earnings performance, expected future stock returns from the current price, and the rebalance is done accordingly. And fresh or follow-on investment in an idea is done only if it can deliver an attractive IRR over a period of the next 3 years. Now we come to the crux of today's presentation. That is, how do I generate new ideas? This is a common question which I keep getting from time to time as regarding how do I come across promising opportunities in the Indian stock market. And this slide basically summarizes my entire idea generation process. Every single day, I diligently review all of the announcements on the Bombay Stock Exchange websites. For many, it's a tedious exercise, but for me, it's like an intellectual treasure hunt wherein I may strike gold at any time. Every single day, I'm creating numerous opportunities for serendipity to find me. I review press releases, investor presentations, M&A deal, joint venture partnership agreements. When I'm evaluating quarterly results of my watchlist companies, then I'm looking for what I call breakout earnings, or what is known as post earnings announcement drift. So a breakout earnings basically refers to a company whose sales have grown more than 50% year on year and whose earnings per share have grown by more than 100 and 200% year on year. And in such cases, the stock market is generally a bit slow to adjust the stock price to the right higher level. So even if you buy those stocks 5-10% higher the next day after that breakout earning, you still end up making pretty good returns. This is what post earnings announcement drift, or PEAD, refers to. I attend the conference calls of my portfolio companies and the companies on my watch list on Trendline, Alpha Street, Research Bytes. Even the company website investor relations section sometimes gives the con call transcripts. One peculiar problem with many promoters of Indian businesses is that they tend to be overly bullish and overly confident during the good times in the industry. So it's very important to corroborate and cross check what they're saying, but what the global peers are saying. What is the commentary and the outlook being given by the global peers? I also go through the management interviews of my portfolio companies and the watchlist companies on print and digital media. I use screening tools like Tijori Finance. It's a very good screener for tracking commodity and chemical prices. Screener.in is very popular among the investing community in India. On Screener.in, I look for companies which have either completed a big capex or which are in the process of completing a very big capex, which you can track by looking at the capital work in progress on the balance sheet. I also look for stocks hitting a 52-week high or an all-time high or a post-IPO new high. Now, when I'm saying post-IPO new high, what I'm referring to is situations where after the initial listing pop, the stock tends to go into a long-term consolidation range for 8, 9, 10 months. And when it breaks out to a fresh new high post IPO, after that 8 to 10 month consolidation, it generally coincides with some important development taking place in that company. And when you're evaluating price action, it's all context dependent. Time frame matters. In a bull market, when you get many stocks hitting 52-week highs regularly, you want to look at stocks hitting multi-year highs. Immediately after a bear market crash, you want to look for stocks hitting a 3-month or a 6-month high. And in a range bound market or a non-trending market or sideways market, you want to look for stocks breaking out to fresh 52-week highs. So time frame matters when you're looking at price action of the stocks. I read the equity research reports of certain brokers whose quality is pretty good. I'll read equity research reports issued by Ambit, ICICI Securities, Spark Capital, India Infoline, Nirmal Bang, Axis. Also read the annual reports and credit rating reports and draft red herring prospectuses or DRHPs and the QIP offering documents are a very good source for understanding the underlying industry of the business in great detail. So for example, if someone wants to understand the dynamics of the music licensing business in India, they can look at the QIP offering document issued by Saregama Limited. They did a QIP of 750 crores a few months ago. I also read the investor letters for idea generation by fund managers whom I admire and respect. I like reading the investor letters written by Solidarity, Sage One, Equirus. I also attend the investing conclaves like Tamil Nadu Investor Association, India Investing Conclave. A less talked about but very useful source for idea generation is fund managers' top 5 holdings from PMS Bazaar website. Now, the sign up is free, and once you have signed into PMS Bazaar website, you can actually open the profile page of any fund manager whom you like and respect, and you can actually look at the top 5 holdings in their PMS along with their allocations as well. So this is again a good source for idea generation. I also review the bulk deals, block deals, and insider buying information on a daily basis. Stockage app does a good job at this. I also look at the 52-week high volume list on a daily basis, because if any company stock is experiencing a 52-week high volume, it generally coincides with some important development taking place in that business or its underlying industry. So that's a good starting point for further research. As far as magazines go, I like to read Fortune India, Forbes India, and Outlook Business. For newspapers, I like to read the Economic Times. And I also review industry-specific websites for idea generation. For chemicals, I look at Chemical Weekly. For steel, I look at Steel Mint. For commodities, I look at Platts. And I also have daily discussions with peers and colleagues in the industry. And I also look for the views of the leading analysts of individual sectors. Finally, we have social media platforms like Twitter, WhatsApp groups, Telegram channels, and online forums like Value Picker and Multiply. Now, I ask all of you this one simple question. If you follow this extensive list for idea generation every single day for the remaining part of your investing career, how can you not be simply flooded with great opportunities at all points of time, be it a bear market or a bull market or a non-trending market? There is no alternative to hard work, and nothing in life will work unless you do. You have to put in the work today to let good luck find you in future. And there is no good reason for you to settle for an inferior track record in a marketplace like India, which is filled with companies having outstanding fundamentals.
I agree. Your first point itself is a big treasure. Corporate announcements. Me and my team closely track this part on daily basis. And it's immense opportunity we'll get to know if you can closely track that part.
I mean, it's like you will get an big advantage over more than 99% of all investors
Yeah.
if you simply review the BSE corporate announcements every day. I mean, this is the fruits and the raw fruits and vegetables basically for any active investor, and this is the primary source for gaining an edge over others. And just by simple rigorous diligence, rigorous perseverance, consistency, you'll get ahead in this game. But in life, business, relationships, or investing, nothing will work unless you do. So, like Peter Lynch said, right? The person that turns over the most rocks wins the game. That is what investing is all about. And especially in a highly competitive field like investing, it's a field of competitive learning. And to perform better than the rest, you have to outwork the rest, you have to outline the rest. So this slide will greatly help you in that particular endeavor. I follow a multi-pronged approach for idea generation. I track the key company metrics like leaders in niche sectors with low competition, healthy balance sheets, high returns on capital employed, good revenue growth. I track the investment activities of private equity funds, hedge funds, and mutual funds whom I admire and respect, as well as the individual investors whom I like to follow. I also track industry developments. I look for sectors undergoing supply side consolidation because that implies lesser competition, and competition creates friction for value creation. So ideally, you want to look for sectors which are undergoing supply side consolidation. A lot of M&A is happening. A good example here is the real estate industry in India. Just look at what has happened over the last 10 years. The unorganized real estate space has basically got decimated post Demon,
Yes.
RERA, and GST. So you want to look for industries which are undergoing a supply side consolidation. You also want to be on the lookout for positive regulatory changes. For example, since early 2020, the Indian government has given a heavy emphasis on ethanol blending. And because of that, you have had many multi-baggers coming from the distillery space. I'm also on the lookout for emerging sectoral adoption trends. A good example here is music consumption. So in the past, we used to consume music through audio cassettes and CDs. But today, we consume music through streaming apps like Ghana, Savan, Wink, Spotify, YouTube, etc. But my favorite way of generating alpha is through tracking corporate events, namely change in promoter and management, merger arbitrage, block deals, demergers, and companies undergoing a significant capex. And let's briefly talk about each of these corporate events with the help of case studies, beginning with promoter and management change. So in August 2020, the stock of CG Power was trading at sub 10 rupee levels. And in 2019, the company had been hit with a 3,000 crore rupee fraud. The perceived levels of corporate governance in the company was abysmal. And that's why the stock was available at a throwaway valuation, even though the underlying assets were pretty good. But the stock markets are ruthless when it comes to bad corporate governance. They just punish the stock down to very low levels and the market cap to depressed levels. Enter the Murugappa Group from South India in August 2020. They announced the acquisition of CG Power, and the Murugappa Group is known for its stellar high standards of corporate governance. And what happens in the stock market is when a company with low levels of perceived corporate governance, low perception in terms of corporate governance is taken over by a private equity firm or a business group with very high standards of corporate governance, you get massive wealth creation. Since August 2020, the stock of CG Power has given more than 1700% returns already. Now, you may well say that this case study has already played out. It has already taken place in the past. But the Indian stock market is a never ending stream of opportunities. You simply have to learn pattern recognition. You have to understand how these various patterns work. So let's look at the next case study. Same thing, change in promoter or management group. So in August 2020, Embassy Group announced the merger of Indiabulls Real Estate with itself, wherein the erstwhile promoters of Indiabulls Real Estate would exit the business. They've already sold down their stake to 0.26% now. And the Embassy Group is known for very good standards of corporate governance. You're also having the chairman of Embassy Group, Mr. Jitendra Virvani, who is having a very good, high stellar reputation in the Indian real estate circle. Plus, you're having the residential real estate cycle in India, which has finally turned for the better after a period of almost 10 years. This is what probabilistic activity is all about. That is what investing is all about. You want to stack as many layers of positive probability in your favor. So here, what are the various layers which have basically stacked in my favor? you're having a very good new promoter led by good leadership. They'll get a leadership premium. They'll get a governance valuation premium. The residential real estate cycle in India is turning around, so that's another positive development. And you're getting it at a reasonable price. So the shareholder meeting will happen in the next 10 days for this particular merger to take place. After that, you'll have the NCLT approval, and finally you'll get the newly merged entity, which will start getting traded on the exchanges and sometime in the first quarter of FY23. So even though the stock of India Bulls real estate has given good returns since the day of I think if the real estate cycle plays out as in a positive manner as expected for the next 4-5 years, we should still make some decent returns from the current levels as well. The next source for added generation is that of block deals. Sometimes in the stock market, you'll notice that even after a blockbuster quarterly earnings report, the stock price does not react. In fact, it goes sideways or even declines at times. And many investors are perplexed as to how this can happen. It may so happen that there is an institutional shareholder, a big institution, which is trying to exit the stock. And it can be for any reason. For example, a new fund manager may have taken over the fund, or they may be facing redemption pressure. Whatever may be the technical short-term reason, but as investors, we are focused only on the underlying business and the intrinsic value, right? And the margin of safety from the current price. So whenever someone sells in desperation, they tend to sell cheap. And as a buyer, I love to be on the opposite side of such trades in which the other party is being forced to liquidate holdings at any price, regardless of underlying value. And this is a special situation. On June 15th, the news came out that Templeton Strategic Emerging Markets Fund sold 2.36 lakh shares of Globus Spirits at 430 rupees per share on the NSE as per the bulk deal data. And as soon as the selling pressure from this institutional seller got absorbed in the stock, since June 15th, the stock of Globus Spirits has given almost 300% returns. While now, a very important point here to again reiterate and repeat is that you keep getting block deals and bulk deals taking place on a regular basis, but to gain the maximum alpha and make the maximum returns in these kind of situations is when these block deals or bulk deals coincide with a blockbuster quarterly earnings report. That is when you want to pay special attention to these block deals and bulk deals. The next added the corporate event which I want to discuss now is that of merger arbitrage. So Benjamin Graham, the father of value investing, used to write several articles for the Analyst Journal, and he penned a seminal article on special situations in the fourth quarter 1946 issue, in which he wrote, in the broader sense, a special situation is one in which a particular development is counted upon to yield a satisfactory profit in the security, even though the general market does not advance. In the narrow sense, you do not really have a special situation at hand unless the particular development is already underway. And Graham concluded the article by summing up the essence of a special situation as an expected corporate development within a time period estimable in the light of past experience. So last year on 24th January 2021, I tweeted about ongoing merger of Minda Industries with Haitha Seating. So if you were a shareholder in Haitha Seating, for every one single share of Haitha Seating, you would get 1.52 shares of Minda Industries. Now, for all advocates of efficient markets, just look at what was happening in this particular situation. The stock price of Minda Industries was 508 on 24th January 2021. And based on the merger ratio of 1.52 to 1, as a shareholder in Haitha Seating, you would receive 1.52 shares of Minda Industries. So 1.52 into 508 equal to 772 worth of shares in a few months' time. And what was the stock price of Haitha Seating? 534, which meant that you would make almost 40% returns in a few months' time just for patiently holding on to your stock and doing nothing else. The patient investor in the stock market gets paid just for simply waiting, because the stock market is characterized by people who are craving instant gratification. Next month on 4th February 2021, Minda Industries reported a great set of numbers, and because of the merger ratio of 1.52 to 1, for every 10% up move in Minda Industries stock, as an investor in Haitha Seating, you would enjoy 15.2% capital appreciation because of the merger ratio. The next day on 5th February 2021, the merger came one step closer to completion and only the Chennai NCLT order remained pending. Finally, the merger got completed on 9th April 2021, and the stock of Haitha Seating was delisted from the stock exchange at a price of 766. And what was the price on 24th January? 534. So you would have made almost 40% returns in 2.5 months through the use of merger arbitrage. Having understood how a merger arbitrage works, now let me share two live case studies with you. Last year in February, APL Apollo announced the merger of Apollo Tricoat with itself at a 1:1 merger ratio. And in July 2021, Equitas Holding announced the merger of Equitas Small Finance Bank with itself at a 2.26:1 merger ratio. Now, I ask all the viewers to simply go and check the stock prices of these four companies to see if there is any merger arbitrage opportunity from the current level. The next corporate event which I like to track is that of companies having completed a significant capex. This is the screenshot of a company from Screener website. Just observe what's happening here. Between March 2021 to September 2021, the gross block or the fixed assets are more than doubled. And this is a pretty well-managed company. In the past, they have generated ROCs of 33%, 28%, 29%. But in the latest financial year, ending March 2021, they reported a small loss. Now, if you were simply following a mechanical screener, in which one of the criteria was net profit more than zero, you would end up overlooking such opportunities, because in these opportunities, you have to do a deep dive to understand how and why did the well-managed company report a loss all of a sudden. In this company's case, it was because it had shut down its existing plant to synchronize with their new plant, and their existing plant was shut down for 4-5 months, because of which they did not generate any revenue, while they kept incurring the fixed cost for those 4-5 months. That's why they ended up reporting a small loss. But now the integration and synchronization of the new plant with the old plant is complete, and the earnings and profits from the new plant will now start flowing in. And this company provides a critical input to the aluminum industry. As we all know, aluminum industry is undergoing a boom, and it's supposed to face, it's expected to face supply shortages up to 2023. So you have the industry cycle in your favor. You're having valuations in your favor, because once this company reported a loss, the stock price basically fell 50% from the 52-week high. So you were able to buy this business at a depressed market cap and a depressed valuation. So again, investing is all about stacking as many layers of positive probability events on your side as possible. That's the best we can do. So be on the lookout for such kind of corporate events. You will always take one of these four risks when you buy a stock: business risk, management risk, valuation risk, or industry risk. And there are only four things that can happen in investing. You can either make a big profit, a big loss, a small profit, or a small loss. And if you can eliminate the big losses, you shall do very well. There is no bigger mistake in investing than holding on to your losers for a long time. Going wrong occasionally is acceptable, but staying wrong is not. Now, I just mentioned that if you can eliminate the big losses, you shall do very well. How can you do that? By avoiding certain things. And there are certain things which I strive to avoid as an investor to avoid those big losses, both for myself and my small case clients, namely investing in commodity and cyclical businesses near the peak of their cycle at peak margins. Now, investing in government-owned companies, because the promoter's key motivation is not wealth creation for shareholders. Investing in project-based businesses dealing with government tenders, because in these businesses, receivables tend to be an issue, in turn leading to cash flow problems. Investing in melting ice cubes, or what I call value traps. Value traps are basically companies which look inexpensive or cheap, but they are cheap for a reason. A good example here is the newspaper stocks in India. For the last decade, they have looked cheap, and they keep on getting cheaper because in the P ratio, basically the denominator, the E, the earnings per share is basically in structural decline. So even though they look inexpensive or cheap, but over time they end up being the most expensive because the underlying earnings are worsening. So be very careful as to the trajectory of the underlying business. If the trajectory is positive, and if you bought the stock at a good valuation, you'll end up making money. But if the trajectory is negative for the business, then you'll end up with permanent loss of capital.
Just 1 second before go to before slide, because many retail investors might get confused. Previous slide.
Yes.
You said you should not hold your losers. Many common retail investor thinks that losers, in the sense, only they take call based on the stock price performance. They ignore the fundamentals. It's not about only the price call, right? It has to add value to the fundamentals as well.
Correct. So you want to basically avoid what I call crumbling castles. So I'll give you an example here. A crumbling castle is a business which is losing relevance among its primary customers. The primary business itself is in decline. A good example here is, for example, Maruti, right? So Maruti right now is not venturing into the electric vehicle space, but because they want to follow a more conservative approach. But if they don't transition to electric vehicles, or they may end up losing relevance with their customers over the next 10 years. So when I talk about losers, I'm referring to the underlying business, that the underlying business of the stock is in structural decline. Stock price basically means nothing. In the short term, it's just noise. And in the long run, stock prices tend to follow earnings growth and free cash flow growth ultimately. And that's what investing is all about in the long term. In the very long term, over 10 years and more, the stock prices tend to converge with earnings growth, because valuation re-rating can only take you up to a particular point. There's a limit to how much the valuation re-rating can happen. But ultimately, it's the sales and profits which will drive your returns in the long term. So the point which I was talking about on this slide was venturing outside my circle of competence, driven by the lure of quick short-term returns in bull market. So this is a problem with many people who are in the market for making quick money. They tend to simply invest based on tips. But like I tell my friends and colleagues, that when you invest based on a tip, you end up falling in a pit. So you want to basically avoid just chasing short-term quick returns. The stock market is not a place for generating daily income. The stock market is a place for building generational wealth. You want to basically you want to think big, you want to evolve to the mindset of the big investors, and think of the stock market as a compounding machine for you. You basically want to invest in a portfolio of good stocks and remain invested for the long term. And when I say invested for the long term, I'm not referring to remaining invested in a single stock of a company for the long term. I'm referring to being invested inside the market in a portfolio of good stocks for the long term, because time and again, the market teaches us that there is a big difference between a great business and a great stock. There are many companies, if you buy great businesses, if you buy them at abnormally high valuations, absolutely high valuations, you will not end up making money for a long time. And there have been, like look at Wipro, for example. I think it's not yet even crossed its 2000, what the price it was at 2000, I think. So 22 years have passed since year 2000, and I think Wipro is still barely above its 2000 levels, if at all. So the price which you pay matters. You can pay high valuations as long as the growth rate of the business is very, very high, because in that case, growth saves you. But if you buy 10-12% growing consumer companies at 100 P's, it's very difficult to understand how will you end up making money. In fact, that P re-rating of these companies was largely driven by the low interest rate regime. Now the interest rate cycle has finally reversed after more than 30-40 years in the US. So from 1982 to 2022, if you look at the US bond yield, basically there has been a 40-year bull market in the bond market in the US because of the declining interest rate regime. But now we are, I think, about to enter a phase of an inflection point in terms of the interest rate cycle in the US. So in such cases, what happens? The first stocks to deflate and derate are the high P stocks and the loss-making company stocks. So you have to be very careful now. You have to understand the underlying market regime. If you want to be a very successful investor, you have to understand the market cycles. And I think Howard Marks has penned a great book on this topic. It's called Mastering the Market Cycle. I think it's an essential read for all investors, because this is also what drives alpha generation. If you can understand the underlying market regime, when I say the underlying market regime, I'm referring to the fact that different stocks and sectors are in favor in different points of time in the market cycle. You have the handful, select few consistent compounders or the compounding stocks in terms of earnings, but the other part of the portfolio in which you have the cyclicals, commodities, special situations, and other tactical opportunities, that's essentially driven by the underlying market regime. Understanding the underlying market regime is critical to be a successful investor. The next point which I'd like to talk about, which I like to avoid as an investor, is investing in companies with bad accounting quality or poor levels of corporate governance. And this is a very big problem with many companies in India, which don't have good accounting quality and good standards of corporate governance. So a question which I keep getting from many people, since I primarily am based out of the US, is that how do I evaluate the management quality of the different businesses in India without actually physically meeting them? It's by following a comprehensive corporate governance checklist. So I check for any frequent change in auditors, any qualifications raised by auditors. Are there any abnormal auditor fees? Is the auditor fees growing faster than revenue growth? Does the company have a long list of unaudited foreign subsidiaries? Does the promoter have political affiliations or criminal proceedings against him? Has the company been subject to CBI, Enforcement Directorate, or IT raids in the past, or any cases of SEBI debarment? What is the history of attrition in the C-suite or the management suite or the CXO level basically? Is the key management personnel drawing excessive remuneration or blowing large sums on a corporate office? So here I'll give an example. There's a domestic pharmaceutical company in India which was finally starting to do the right things in terms of improved disclosures and better standards of corporate governance. But then they suddenly, out of nowhere, announced spending 200 crores on their new corporate office. Now, as a minority shareholder, you would obviously feel bad that the management is basically spending 200 crores of your money on just a flashy corporate office. So, in investing, what I've seen over the last 15 years is the most frugal and cost centered and management with a razor sharp focus on cost cutting and efficiencies. They ultimately deliver wealth for the shareholders, not the companies which blow large sums on empire building and lavish corporate offices. You also want to check for the history of equity dilution by the company. You want to check for any promoter pledging. Also check whether the promoter holding is coming down. Check the history of sharing wealth with the minority shareholders in the form of dividends and share buybacks. Check what the credit rating reports are saying. Check if any related party transactions are present and are they very significant. Check the views of current and ex-employees. You can get this information on websites like Glassdoor. What are the industry experts saying about the company? What are the reputed investors saying about the company? Does the promoter have a similar business as the listed entity in his private company? Because that may lead to a conflict of interest. I also evaluate the accounting quality. And when I say evaluation of accounting quality, I'm referring to situations like, for example, volatility in depreciation rate, because the depreciation rate can be modified by the management to manipulate earnings. I also check if any expenses has been written off directly from the balance sheet against reserves and surpluses instead of being routed through the profit and loss statement, thus inflating profit. I check for any aggressive revenue recognition policies by the management. Is the business working capital intensive? Is the trend in accounts receivable and inventory days worsening? What is the historical CFO to PAT ratio? What is the historical CFO to EBITDA ratio? Because that tells me how much of the reported earnings are being converted into cash flow from operations. Ultimately, at the end of the day, CFO or cash flow from operations are about fund your financing and investing activity like capex, M&A, dividends, or share buybacks. You should also check for any abnormally high margins versus the peers in a commodity industry. So if a commodity business is earning, suppose 30% margins compared to its other peers in the same industry, which are earning 10% margins, that should make you alert, sit up and take notice and do a deep dive as to whether there are any red flags present or not. Also check if there have been any excessive write-offs of assets in the past by the company. Check if the company is capitalizing its operating expenses. Here, a good example is from the Indian pharmaceutical industry, for which research and development or R&D is a very common line expense item. But some managements tend to capitalize R&D to smooth out earnings, whereas the more conservative managements expense out the full R&D in the very year in which it is incurred. I also check for trends in the debt to equity ratio, whether the company has defaulted on any statutory payments in the past. Does the company have high contingent liabilities? Is there any off-balance sheet obligations? For example, has the promoter given any guarantee on his other group entity's debt through the listed entity? Now, some people may ask, what is the need to do so much hard work? No one looks at balance sheet or cash flow in a bull market, let alone the footnotes to the financial statements. The answer to that is, when you have been entrusted with advising and managing other families' hard-earned savings and wealth, then you owe it to them to reciprocate their trust in you. And following this extensive checklist actually helped me a few months ago from adding a particular company in my FlexiCap small case. It was a specialty chemicals company catering to the textiles industry. And the management was coming on various business channels, giving very positive and bullish commentary. They were also announcing some high profile tie-ups with some foreign partners. But one deep dive into its annual report, and there were red flags galore. Even though the stock is hitting a 52-week high in the recent few days, I basically want to avoid partnering with unethical managements and managements which basically are reporting high profit growth but are not really following shareholder friendly practices. And what I've seen in the last 15 years is that the all these sins and mistakes of during a bull market, eventually you have to pay for them in the subsequent bear market. And I really don't want to go back to the starting position. The key to compounding is survival and endurance. And at Stellar Wealth Partners, we focus on long-term survival, endurance, and sustainability above all else because we understand how long-term compounding works. We are happy with steady, healthy returns over a long period of time rather than chasing abnormally high returns during a year or two of a bull market in between. So that's not how we practice long-term wealth creation here.
And even that management has a habit of every bull market giving these statements, right? So
yeah, there are many. In fact, without naming the company, there is a particular business which basically the last bull markets, every bull market they change their name and they basically keep resurfacing in new OfThe. And this is where experience basically helps you because you know the past antics of these managements. So even though they have changed their company name to suit the raging new trend and fad and fashion of the current times, you basically want to avoid partnering with such managements and entrusting your hard-earned money in those businesses because ultimately when the bear market comes in the future, which it will at some point of time, that is when you end up with permanent loss of capital. So in my last 15 years of experience, one of the big eureka findings and big moments for me has, and the biggest learnings for me has been this one thing, that only quality businesses with good quality managements, the stocks of only these category of businesses tend to rebound the fastest after a bear market, because how much paper profit you make in a bull market basically becomes irrelevant. In the long term, it means nothing. As if you cannot, making money is relatively easier, but retaining that money is very tough. That is an entire different ball game altogether by itself. So I think over the long term, what we investors realize is that preserving your hard-earned wealth is much more tougher than actually growing it during a bull market. It's the preservation and the steady accumulation of this hard-earned wealth over the long term. That is what is very important and difficult at the same time. And that's why you see very few rich people from the stock market, right? Because hardly any of them are able to sustain over the few decades. The last 20 years, we keep hearing about the same names again and again. Mr. Vijay Kedia, Ramdev Agarwal, Ramesh Damani, R.K. Damani, and just a few other names. And the same names keep on repeating. Why is that? Because even though the market has given phenomenal returns over the last 30-40 years, but very few people have been able to hold on to their their wealth, which they made during the periodic bull market. So it's very important to avoid, again I come back to the previous slide, it's very important to avoid the big losses. Many people are unable to sustain in this game for the long term, and compounding is a long-term journey, and an individual's impatience with his or her investing process may bring your journey to a fatal end. So you have to be more disciplined than the rest in this business. You don't have to be smarter than the rest in this business. You just have to be more disciplined than the rest. Another important thing which I strive to avoid as an investor is taking a short-term view, because like I said, investing is a long-term game. And the more time you give it, the higher the odds of success. And why do I say this? It's because in the short term, as shown in this particular chart as well, in the short term, within a period of less than 1 year, almost half of the stock price performance or the stock price movement is driven by sentiment or the changes in the valuation multiple. But as you can see on this particular chart, over the long term of more than 10 years, almost 90% of the stock price performance is driven by sales and profit growth. In the classic book on valuation, which I highly recommend to everyone who wants to become a serious investor, the name of the book is Valuation, Measuring and Managing the Value of Companies. The authors write, and I quote, "We have found empirically that long-term revenue growth, particularly organic revenue growth, is the most important driver of shareholder returns for companies with high returns on capital." Traditionally, there have been three sources of edge for the individual investor. First one was the information edge, but with the advent of the internet and widespread dissemination of information, the information edge is basically gone now. The second source of edge traditionally for investors has been the analytical edge, but with more and more smart people entering the investing profession, even the analytical edge is fast getting compressed. But the one edge, which in my view is the most durable and sustainable, is that of behavior and temperament. Shane Parrish of Farnham Street blog writes in a quote, people who arbitrage time will almost always outperform. The first order thought of instant gratification is a crowded path, ensuring mediocre results at best. Delayed gratification, which requires second order thinking, is less crowded and more likely to get results. This is why Howard Marks has written, and I quote, rule number one, most things will prove to be cyclical. And rule number two, some of the greatest opportunities for gain and loss come when other people forget rule number one. 50 years ago, the best investors were the ones with an informational edge. Today, the best investors are the ones with a behavioral edge. As the speed of information dissemination in the markets and competition for short term outperformance among money managers increased over the years, time horizons and patience levels significantly decreased. Today, an investor's edge is less about knowing more than others about a specific stock and more about the mindset, discipline, and the willingness to take a long term view about the intrinsic value of a business. And I've written about this in extensive detail in my book's chapter on delayed gratification. And implementing the principles from that chapter have helped me achieve some of my biggest multi-baggers till date. Let me quote an extract from that particular chapter. Investors generally overlook businesses that are doing things that will create significant incremental earnings 1 to 2 years from now because they don't want to wait that far out. Investors often shun businesses that are investing for the future and currently are suffering from low initial margins in those new initiatives because capacity gets utilized only over time and the earnings growth is back ended. Even if they execute well, they will see little reported earnings growth for the next 4 to 8 quarters and may even see a decline resulting from incremental depreciation and poor initial margins. Even if they're expected to experience an exponential jump in earnings growth after that, the stock markets generally do not initially increase the market value of these businesses. They do re-rate them, however, around the time when the earnings growth is clearly visible. And as investors, we get an edge over competition if we pick these companies and have the patience and conviction to hold them. Although these businesses are clearly undervalued on a longer term basis, it is psychologically challenging to invest in them and even more so to hold on to them. And these difficulties result in a lack of investors and the subsequent mispricing of these stocks because the price discovery is weak when investors' attention on these stocks is low. Let me illustrate this with the help of a personal example. During 2018 and 2019, the Indian auto industry entered a down cycle post the NBFC crisis, and there was an auto ancillary company named Rajratan Global, which was undergoing a big capacity expansion. Because the entire auto sector was out of favor, the investors' attention on this particular stock was low. But as soon as the capacity expansion got over and the earnings visibility went up post a recovery in the auto cycle, the stock of Rajratan Global has given more than 1000% returns since April 2020. And this is deep value investing at its finest. And this is why Howard Marks said, and I again repeat, rule number one, most things will prove to be cyclical. And rule number two, some of the greatest opportunities for gain and loss come when other people forget rule number one. You want to buy such capex plays during the industry down cycle because you get to buy them at depressed valuation and depressed market caps. And then you simply need to patiently hold on to them through the full industry upcycle. And that is how you reap maximum capital appreciation. And when you're investing in those businesses during the down cycle, just simply check their balance sheet to see if they can survive for the next 2 to 3 years of a continued downturn. And if the answer to that is yes, then you buy them at great prices and patiently hold on, because once the cycle turns, which it eventually will do, then you end up making life-changing multi-bagger returns. Now, successful investing is all about pattern recognition. Recall what I just said a few slides ago, that the stock market generally do not initially increase the market value of these businesses. They do re-rate them, however, around the time when the earnings growth is clearly visible. On 10th January last year, 2021, I had tweeted about a company named Ultramarine Pigments, which had completed a big capacity expansion and was trading at a low valuation. And my thesis was that earnings growth coupled with margin expansion should now lead to pre-rating, because the new capacity expansion was done in the higher margin business of surfactants. And since January 10, 2021, the stock of Ultramarine Pigments has given 40% returns till date. Now, I had mentioned about how successful investing is all about pattern recognition. pattern recognition is so important that I've dedicated an entire chapter in my book to it. And in that chapter, I've shared various catalysts for re-rating through the use of management and market signals. And I quote from that chapter: along with the slow and gradual macro changes, investors should also be alert to tiny changes at the macro level, be alert to tiny changes like the declaration of a maiden dividend, receipt of a large order or a landmark contract, appointment of a big four auditor, increased or first time disclosures or discussion about business prospects and future plans in annual reports, presentations, or press releases, a chairman or a CEO of a listed company sharing business commentary for the first time, a company holding an analyst or investor conference call for the first time or after a long time, an upgrade of a company's debt instruments by the rating agencies, a sudden increase in the market value of a company's bonds because bonds are more sensitive than stocks to changes in the economic fortunes of a business, or notable improvements or deteriorations in the working capital cycle. Always monitor the direction of the quality of earnings. And such an elaborate and exhaustive exercise requires total dedication on part of the investor, but it is highly rewarding. Note what I just mentioned, that one should always monitor the direction of the quality of earnings.
I saw multiple tweets of yours on this topic because you've been tweeting many companies. The directional change is one you emphasize many times. That is what I have observed.
Yes, but it's because investing is all about delta, the rate of change, and we should always focus on the rate of change in earnings growth and its underlying quality. And Warren Buffett has very aptly said that a business should be viewed as an unfolding movie, not as a still photograph. Look at this snapshot from the annual report of a company in India. It's a very old company. It was incorporated in 1919, so it's more than a century old business. From 1919 to 2005, it was in the fertilizer business, and in 2005 they shut down the fertilizer business and shifted to manufacturing of low margin bulk chemicals. And from 2011 onwards, they started focusing on specialty chemicals business with operating margins of more than 30%. This business came out with a detailed investor presentation on 10th February 2021, in which they outlined their capex program. And as soon as the earnings visibility about this business went up among the investor community post the release of this presentation, the stock of Dharamsi Moraji Chemicals has given more than 50% returns till date. So that was the first pattern about monitoring the direction of the quality of earnings. The next pattern which I would like to share today is that of increased or first time disclosures or discussion about business prospects and future plans in annual reports, presentations, or press releases. Recall the slide on idea generation from the beginning of this presentation, in which I talked about how you have to work hard today to let good luck find you in the future, and how I review the BSE corporate announcements on a daily basis, including press releases and investor presentations. This is the snapshot on the right hand side of this slide from the investor presentation of a macro cap company as of 1st November 2021. In that presentation, they had mentioned about doing a capex of almost 100 crores and expecting 3x asset turns. And if you simply looked at open screen and looked at the trailing 12 months sales of this business, they were doing sales of 100 crores. And from this new capacity, they're expecting sales of 300 crores additional revenue. So you are getting an opportunity for almost quadrupling of the revenues of this business and the new capacity would come on stream in second quarter of 2023. So basically within 2 years from the release of this investor presentation, you were expecting a quadrupling of revenues. And since 1st November 2021, when this investor presentation was released for the first time by the business, the stock of natural capsules has given more than 100% returns already. So that was the second pattern. The third pattern, which I would like to discuss today, is that of receipt of a landmark contract. So in early February 2020, Navin Fluorine won a 7-year high performance product contract worth 2,900 crores. And since February 2020, the stock of Navin Fluorine has given almost 150% returns in absolute terms. Now, a very interesting point to notice here is out of the 150% stock price return since February 2020, almost 100% of those 150% has come from P re-rating. So the P has basically got re-rated from 40 to 80. And we as investors need to understand, why did this happen? Why did the P ratio or the valuation multiple of Navin Fluorine double after winning that landmark contract? And this is what is referred to as the art of valuation. To be a successful investor, You don't need to do a precise DCF calculation on a spreadsheet or an Excel. You just need to have a DCF mindset, focusing on drivers of terminal value, because that is ultimately what drives multiple re-rating and multiple de-rating. Be a business analyst, not a securities analyst. Intelligent investing is all about understanding intrinsic value. And in my book, there's an entire chapter on intrinsic value. And I quote from that chapter. Let's go back to first principles, thinking the basics. The intrinsic value of an asset is the sum of the cash flows expected to be received from that asset over its remaining useful life, discounted for the time value of money, and the uncertainty of receiving those cash flows. Valuation is an art form. Determining the present value of all the future cash flows of a business involves looking at the various aspects of a business's DNA, including its capital intensity, business model durability, balance sheet strength, profitability, competitive position, future growth prospects, and management bandwidth, among other factors, all weighted and compared with the current price. Some businesses are easier to value than others. Predictability of cash flows is an important factor. In other words, it is easier to value a business with stable operations and cash flows than a business with high volatility in its underlying operations every year. The intrinsic value is the sum of the present value of the cash flows during the explicit forecasting period and the present value of the terminal value. Less predictable cash flows need to be discounted at a higher rate. Most important slides in this presentation, which talks about what drives the valuation multiple. It is the perception among the investors about the riskiness of the cash flows, which in turn drives the discount rate they use to value the business, and that in turn drives the valuation multiple. The market places a heavy weight on certainty, and stocks with the promise of years of predictable earnings growth tend to go into a long period of overvaluation until such time that they are no longer able to grow earnings in a steady manner. Predictability of long-term growth matters more to the market than the absolute rate of near-term growth. So a stock that promises to grow earnings at 50% for the next couple of years with no clarity thereafter is given a lower valuation multiple by the market than a stock that has slower but highly predictable growth for a much longer period. Consistent growth increases valuation, consistent disruption decreases valuation. And the longevity of growth is always given a greater weight by the market than the absolute rate of growth. So you will often notice stocks with 12 to 15% predictable earnings growth for the next 10 to 15 years, getting current year P multiples of 40 to 50 times. And this phenomena perplexes most new investors, but with experience, they come to appreciate the finer nuances of the market and respect its wisdom. The expensive, high quality secular growth stocks tend to remain at elevated valuations for extended periods of time, because investors in such stocks generally are willing to sit out periods of high valuation until earnings catch up. And markets provide disproportionate rewards to companies that can provide years of sustainable earnings growth. So in case of Navin Fluorine, once they had 7 years of minimum sustainable earnings growth through that 2,900 crore contract, that's why the P multiple basically got re-rated on the upside. And let's share a few more examples here, because this is very important to ingrain in our minds as investors. It is the risk perception of the cash flows. It's about the perception regarding the volatility of the cash flows that drives the discount rate used by investors to value a business. That in turn drives the valuation multiple. So a good example here is Saregama recently raised 70 crores through the QIP method. And even though the stock of Saregama had already got re-rated leading up to the QIP, the moment they mentioned that they will use the entire 70 crores in their highly profitable music business, and they will not spend a single rupee in the unprofitable loss-making Karma or film production business, the risk perception among the investors regarding the future cash flows of this business got further improved, and their discount rate further reduced, and the valuation multiple they were using to value Saregama further went up. Another example. Today, Solara Active Pharmaceuticals, again, this is not a stock recommendation. None of these stocks we discussed about in this presentation are stock recommendations. They're only for educational and illustrative purposes. We may hold some or all of these stocks in our small case model portfolios or proprietary accounts. So please do your due diligence. But it's very important to understand this particular principle. So Solara Active Pharmaceutical today trades at a low valuation multiple because a large part of the business is driven by the commodity ibuprofen business. But over the next 4-5 years, if they're able to scale up their non-ibuprofen and the CRAMS business to a larger percentage of their overall revenue pie, then you'll notice that the risk perception among investors regarding the future cash flows of Solar Active Pharmaceutical. That risk perception will come down. The discount rate they use to value the business will come down, and therefore the valuation multiple will go up. The stock may get further re-rated, provided they are able to execute on what they are promising. So this is what I refer to as having a DCF mindset. You just want to focus on the drivers of terminal value of the business, because investing at the end of the day is all about understanding terminal value. Because that is where the bulk of the value of any business lies. Any business, again, we go back to first principles. When we invest in a company, we assume that the business will be a going concern and it will operate for an indefinite period of time, for a long time, basically. So that's why it's very important to understand what is driving the valuation multiple of any business in the stock market. It is this, the risk perception of the cash flow. And at the end, I mentioned about how markets are providing disproportionate rewards to any company that can promise years of sustainable earnings growth. And why is that? It's because the longevity of growth is becoming increasingly scarce in today's world, which is characterized by a rapid pace of change. Just look at the statistic. Fewer than 12% of the Fortune 500 companies from 1955 were still on the list 62 years later. And 88% of those companies had either gone bankrupt or had merged with or were acquired by another firm. And if they still exist, they had fallen from the top Fortune 500 companies list as ranked by total revenues. And this is Joseph Schumpeter's creative destruction at its very best. In summary, companies with high longevity, higher duration of cash flows have higher intrinsic value. If there is one big thing that has benefited me immensely in my investing, trading, and wealth creation journey over the years, it is this: listening very attentively to and learning from peers, seniors, and juniors who are much more smarter and hardworking than me. One should always be humble. And the more you reach out to and associate with individuals, whether younger or older, who are better and smarter than you are, the more you will learn and the faster you will improve. It is better to be an average guy on a star team than a star on an average team. The former will be better for you in the long term. The latter is just an ego trip. And always remember that the people closest to you play an outsized role in your level of success or failure. So choose wisely. You are, after all, the average of the 5 people you associate with the most in your life. The great thing about today's digital age is that there are so many bright and hardworking investors and traders on Twitter, WhatsApp groups, and Telegram channels. And all I need to do is listen attentively to what they are sharing and then just do this required study at my end. There has never been a better time to be a humble and grounded person. And Ralph Waldo Emerson had said, "Every man I meet is my master in some point, and in that I learn of him." Learning and accepting help from others creates value far beyond our individual capabilities. Look at every interaction as an opportunity to learn from the people you meet. You will be amazed at how quickly you grow and how much better you become, both as a professional and, more important, as a human being. So, what is the big insight that we get from all this? It is that all intelligent investing is value investing. If I had not self-educated myself on different areas of value in the markets and instead restricted myself to only one way of investing, then I would have never been able to participate in broad-based bull market. And always remember, sector rotation is the hallmark characteristic of any true bull market. If you're not having rapid sector rotation, the earnings growth is not broadening across industries and sectors, then it is not a bull market. And it's a narrow market. And narrow markets ultimately lead to big bear market crashes. That's what history tells us. As the market becomes more narrow, it's more of a precursor to an eventual bear market crash. And my personal investment opportunity set has significantly expanded over the years with time and experience in the markets. Initially, I started off by investing in low price to earning, low price to book stocks because, like most investors, I started off by reading Benjamin Graham's Intelligent Investor. Then I read about Buffett, Fisher, Munger, and I started investing in quality businesses at reasonable valuations. But today, it covers multiple areas of the investment universe, including commodities, cyclicals, deep value, demergers, reverse mergers, turnarounds. And instead of being restricted by my personal biased views to a small opportunity set, as was the case during my early years, I'm now able to invest in a variety of industries and situations wherever I find mispricing of value and a highly favorable risk and return trade-off. You see, no single strategy works all of the time and in every kind of market. And that is why it is essential to build up one's investing arsenal to be able to hunt for value from within different areas. And over the years, I've come to realize and appreciate just why this is so critically important. It is because a bull market is always going on at all points of time, in some specific sectors of the Indian stock market. Between 1960 to 2000, it was in technology, media, and communication. Between 2003 to 2008, it was in infrastructure, commodities, real estate, and organized retail. Between 2009 to 2014, it was in discretionary consumption, pharmaceuticals, IT services, and FMCG. Between 2015 to 2018, it was in autos, specialty chemicals, financials like NBFCs and microfinance companies. And since April 2020, you're having a new bull run in various subsegments within India's manufacturing industry, particularly focusing on import substitution or the Atmanirbhar Bharat scheme. You've also had a new run starting in CDMOs or contract development and manufacturing organizations, CRAMS, which are contract research and manufacturing services. After the revival of the residential real estate, you're having a bull run which has started in building materials, housing finance companies. Government of India is giving a heavy emphasis on ethanol blending. So there also you have had many multi-baggers emerging. Digital transformation, cloud computing have got a big boost post-COVID. And electric vehicles is also a big theme in play right now. And it is my personal conviction and belief that the opportunities in the next 20 years in India will be far greater than those in the past 20 years. And the opportunities of the last 20 years will be dwarfed by the opportunities of the next 20 years. And where will those opportunities come from? They'll come from two sources: variant perception and long-term structural trends. Variant perception refers to having a differentiated view on the short to medium-term trajectory of the business. And variant perception refers to situations where you get earnings growth coupled with ROC expansion, and you get valuation re-rating, and you end up having multi-baggers. And there are various triggers for variant perception, namely product mix change or entering into a new higher margin product category, capex, that in turn can lead to operating leverage, because as the pre-production costs get recovered, after that, for every percentage increase in revenue, the profits tend to increase disproportionately faster. You also get variant perception from an industry cycle shift. So we already talked about how the residential real estate cycle in India has shifted for the better after many years. You're also seeing a industry cycle shift in capital goods and textiles at the moment. So that's also a source for variant perception. A positive regulatory change. So we have already given the example of ethanol blending here. Deleveraging is another source for variant perception. So as debt gets repaid, debt goes down, interest costs go down, net profit goes up, market cap goes up. Improvement in asset turns. This is also a good source for variant perception. So you can get this information from the management conference call. You can ask them how much will be the expected turnover on the new capacity expansion. And there are two sources for ROC expansion, basically margin improvement or an improvement in asset turn. And between the two, I prefer improvement in asset turns because high margins tend to attract competition. Corporate actions, like we discussed, are a good source of variant perception, namely demergers, reverse mergers, promoter management change. Divestiture of any loss-making business or divestiture of a non-core business is another source for variant perception, because the stock market likes focus. So many conglomerate businesses in India tend to get what is known as a conglomerate discount. But as soon as they divest of the non-core business, the valuation multiple gets re-rated. Similarly, if you sell off a loss-making business, then the remaining company's net profit goes up, market cap goes up. This is what we basically focus on in Stellar small flexi-cap small case. We primarily focus on variant perception. Here, I would like to share a very, very important principle of value creation with all of you. And if you can imbibe this for the remaining part of your investing career, you shall do very, very well. In the stock market, there are two kinds of businesses: one with low returns on capital, one with high returns on capital. In case of companies with low returns on capital, the maximum delta, the maximum rate of change, the maximum intrinsic value creation happens when they focus on improving their return on capital employed. And in case of companies with high returns on capital employed, the maximum delta, the maximum rate of change, and the maximum intrinsic value creation happens when they focus on increasing their top line growth. So the former category, the low returns on capital employed shifting to higher returns on capital employed, is identified through use of variant perception. And the latter category of companies having higher returns on capital, which should focus on increasing top line growth, that is found in long-term structural trends. And long-term structural trends are found in companies having their presence in industries with a favorable structure. So generally, these industries are organized as a monopoly or a duopoly or an oligopoly at best. They're experiencing some form of an industry tailwind. They have consistency and predictability of cash flows. There's a long runway for growth, so you have high visibility for many years ahead. They also tend to be characterized by value migration. So in India, we have had value migration going on from unorganized to organized, public to private, offline to online. And there are multiple structural growth plays available in India. CDMOs, CRAMs, contract manufacturing, specialty chemicals with critical application, animal healthcare, fintech, music streaming, e-commerce, electric vehicles, digital transformation, and cloud computing. And these are the various long-term structural trends we focus on in Stellar Wealth mega trends, small case. Both FlexiCap and mega trends, small cases, are benchmark agnostic portfolios of 25 to 30 names. And if anyone wants to understand the logic or the rationale for having 25 to 30 names in both the portfolios, it is because that is the optimal number of holdings to maximize the risk and return trade-off. As per a study published in the international bestseller A Random Walk on Wall Street, it was demonstrated how, as the number of stocks in a portfolio reaches 25 to 30 names, the incremental volatility reducing benefits of diversification reach near zero. And this is the sweet spot for an active investor seeking to outperform the market. At 25 to 30 stocks, you have captured almost all of the benefits of diversification, yet the number of companies you need to know thoroughly is still manageable. I'll conclude with a brief about how value investing, in my view, resembles a life discipline. So, investing is a field of competitive learning. And like I said, if you want to outperform the rest in this industry, you have to outlearn the rest. Warren Buffett has very aptly said that the more you learn, the more you'll earn. And Benjamin Franklin concurs. An investment in knowledge pays the best interest. In August 2016, Michael Mauboussin titled a brilliant white paper titled 30 Years Reflections on the 10 Attributes of Great Investors. And in one of my past interviews on Stock and Ladder blog, I had outlined those 10 attributes along with some of the best books on each of these attributes for the benefit of all readers. And let me share those 10 attributes with all of you. Be numerate and understand accounting, understand value, properly assess strategy, compare effectively, think probabilistically, update your views effectively, beware of behavioral biases, know the difference between information and influence, position sizing, and reading. And I'd added 3 more important attributes to that list of Michael Mauboussin, namely extreme levels of patience coupled with the ability to act decisively and the no-brainer opportunities present themselves, multidisciplinary thinking, and inversion. So if I could simply summarize this slide in one line, it is by this, that the best investment you can make is an investment in yourself. So keep learning, keep growing. The value investing discipline has certain finite aspects that we come to realize and appreciate only with the passage of time and with experience. With the passage of time, we learn to recognize that value investing is not merely about stocks and business fundamentals. It is a life discipline. And I've shared the same in my book's chapter on overrated and underrated behaviors. And let me share a few of them with all of you. Knowledge is overrated. Wisdom is underrated. Intellect is overrated. Temperament is underrated. Outcome is overrated. Process is underrated. Forecasting is overrated. Preparation is underrated. Confidence is overrated. Humility is underrated. Conviction is overrated. Pragmatism is underrated. Complexity is overrated. Simplicity is underrated. Analytical ability is overrated. Personal behavior is underrated. Having a high income level is overrated. Inculcating a disciplined saving habit is underrated. Competition with peers is overrated. Helping them is underrated. Large personal net worth is overrated. Good karma is underrated. Talent is overrated. Resilience is underrated. Being the best investor is overrated. Being the most authentic version of yourself is underrated.
Awesome.
I'll conclude with 2 key messages from my book, that the goals of investment should be happiness, joy, growth, intellectual satisfaction, and peace and serenity. Wealth and financial prosperity are natural byproducts of lifelong learning, and many people achieve success, but to sustain the same and potentially build on it over an entire lifetime requires humility, gratitude, and a constant learning mindset. For any feedback or queries, feel free to connect with me on stellarwealthpartners.com. I can also be reached on LinkedIn and Twitter. You can learn more about my chapter, which is titled The Discipline of Investing, at getchapter.app/Gautam. Readers can get their copy of the book on Amazon, Google Play Books, and Book Depository website. And you can also email me at info@stellarwealthpartners.com. With that, I come to the end of my presentation. Thank you, Sai.
It was wonderful presentation, Gautam. I'm sure my viewers would have taken back a lot of points from this presentation. Guys, ఈ వీడియోలో మనకి గౌతమ్ బేద్ గారు తను పర్సనలీ ఫాలో అయ్యి ఇన్వెస్టింగ్ స్ట్రాటజీస్ ఏవైతే ఆ స్ట్రాటజీస్ అన్నిటిని డీటెయిల్గా షేర్ చేశారు కదా. అండ్ ఐఎమ్ షూర్ మీకు కూడా నేర్చుకోవడానికి అయితే చాలా హెల్ప్ఫుల్ అయింది అనుకున్నాను. అలాగే ఛాన్స్ దొరికింది కదా అని గౌతమ్ బేద్ గారిని అండ్ పర్సనల్ సైడ్ తన ఎంటైర్ జర్నీ గురించి, తను ఇండియా నుంచి యూఎస్ వెళ్ళి యూఎస్ఏలో తను యాక్చువల్లీ పోర్ట్ఫోలియో మేనేజర్ కింద ఎదిగారు. ఇట్స్ ఎ వెరీ ఇన్స్పైరింగ్ జర్నీ. సో ఆ జర్నీ గురించి షేర్ చేయమని అడిగాను. మీకు ఇప్పుడు ఒక శాంపుల్ ప్లే చేస్తాను, అంటే తను షేర్ చేసిన జర్నీలో ఒక చిన్న ట్రైలర్ ప్లే చేస్తాను.
I was rejected in my first 3 stock market job interviews within the first 6 months of coming to the US, and at the same time I ran out of whatever little money I brought with me from India, and to take care of my living expenses in the US I took up a minimum wage job as a front desk clerk at a hotel in San Francisco. At this stage I would like to also share and highlight to you the power of passion. I remember during those 15 months at the hotel, every single night I used to apply to a minimum of 3 stock market jobs online, to face rejection more than 1300 times and still keep on going is only possible if you're here. Is where the book story comes in now. In my book I've written a chapter on good karma, and there's a reason for it. In May 2019 I was at Creighton University in Omaha, Nebraska during the Berkshire Hathaway annual meeting weekend.
సో గైస్, గౌతమ్ బేద్ గారి పర్సనల్ జర్నీ ట్రైలర్ ఎలా అనిపించింది? ఇంట్రెస్టింగ్ అనిపించిందా? యాక్చువల్లీ ఆ ఇంటర్వ్యూ చాలా ఇన్స్పైరింగ్ అనిపిస్తుంది. ఎందుకంటే ఆయన ఇండియా నుంచి యూఎస్ వెళ్ళి అక్కడ ఒక హోటల్లో పనిచేసి అండ్ అక్కడ ప్రిపేర్ అయ్యి ఒక పోర్ట్ఫోలియో మేనేజర్ కింద ఎలా ఎదిగారు ఉన్నది ఆయన షేర్ చేసిన జర్నీ పార్ట్ ఏదైతే ఉన్నదో చాలా చాలా ఇన్స్పైరింగ్ అనిపిస్తుంది. ఈ ఎంటైర్ మన టాక్, పర్సనల్ 1-to-1 టాక్ ఏదైతే ఉన్నదో ఈ టాక్ని మన టాక్స్ ఛానల్లో రిలీజ్ చేస్తాను. సో దీన్ని నెక్స్ట్ వీక్లో రిలీజ్ చేద్దాం అనుకున్నాను, ఎందుకంటే ఈరోజు సాటర్డే ఆల్రెడీ ఫుల్ లెంత్ 1 hour ప్లస్ వీడియోని ఇప్పుడు రిలీజ్ చేస్తాం. రేపు మన ఆస్క్ మనీ పర్ షో వస్తుంది. ఆస్క్ మనీ పర్ షోలో కూడా చాలా ఇంపార్టెంట్ టాపిక్ స్టార్ట్ చేశాను కాబట్టి రేపు రిలీజ్ చేయడం కూడా కరెక్ట్ కాదు. సో నెక్స్ట్ వీక్లో మండే టు ఫ్రైడే ఆర్ సాటర్డే లోపల ఎప్పుడొకప్పుడు రిలీజ్ చేద్దాం అనుకున్నాను. ఐ నీడ్ యువర్ ఫీడ్బ్యాక్ ఆల్సో. ఏ రోజు రిలీజ్ చేయాలో కింద కామెంట్ సెక్షన్లో షేర్ చేయండి. మీలో ఎక్కువ మంది ఏ రోజు రిలీజ్ చేయమని చెప్తే ఆ రోజు నేను ఈ ఎంటైర్ పర్సనల్ టాక్ ఏదైతే నడిచిందో మా ఇద్దరి మధ్యలోనే అది షేర్ చేస్తాను. యాక్చువల్లీ వన్ ఆఫ్ ది ఎవరైతే యంగ్ పీపుల్ ఉంటారో యంగ్ పీపుల్కి అయితే చాలా ఇన్స్పైరింగ్ అనిపిస్తుంది. ఎందుకంటే మళ్ళీ చాలామంది అనుకుంటాం ఆ లెవెల్ వరకు ఫండ్ మేనేజర్, పోర్ట్ఫోలియో మేనేజర్ వరకు ఎదగాలని. సో ఎదగడానికి ఆయన పెట్టిన ఎఫర్ట్స్ ఏవైతే ఉన్నాయో అవన్నీ బాగా అనిపిస్తాయి. అది కూడా మన ఇండియాలో కాదు, వేరే కంట్రీకి వెళ్ళి అక్కడ ఆయన పెట్టిన ఎఫర్ట్ అండ్ ఆయన ఎలా పోర్ట్ఫోలియో మేనేజర్ అయ్యారు అండ్ ఒక బుక్ని ఎలా రాశారు, ఆ బుక్ రాయడానికి వెనకాల ఇన్స్పిరేషన్, ఇవన్నిటి గురించి కూడా షేర్ చేశారు. చాలా ఇంట్రెస్టింగ్ వీడియో అది. అండ్ ఒకవేళ మీరు మన టాక్స్ ఛానల్ ఇప్పటివరకు సబ్స్క్రైబ్ చేయనట్టయితే ఇక్కడ మన ఏదైతే లోగో వస్తుందో టాక్స్ ఛానల్ లోగో, ఈ లోగో మీద క్లిక్ చేసి టాక్స్ ఛానల్ సబ్స్క్రైబ్ చేయండి. అండ్ అలాగే ఈ వీడియోని ఇప్పటివరకు లైక్ చేయనట్టయితే తప్పకుండా లైక్ చేసి మీ ఫ్రెండ్స్ అండ్ ఫ్యామిలీ మెంబర్స్కి హెల్ప్ఫుల్ అవుతుందంటే వాళ్ళకి తప్పకుండా షేర్ చేయండి. అండ్ ఒకవేళ మీరు ఈ వీడియోని, ఇప్పుడు చూస్తున్న వీడియోని నేను రిలీజ్ చేసిన 1 week 10 days తర్వాత చూస్తున్నట్టయితే ఆల్రెడీ ఈ జర్నీ పార్ట్ వీడియోని కూడా రిలీజ్ చేస్తుంటాం. అది ఇక్కడ ఎండ్ కార్డ్లో వస్తుంది. తప్పకుండా మిస్ అవ్వకుండా చూడడానికి ప్రయత్నించండి. మరొక ఇంట్రెస్టింగ్ వీడియోతో అయితే కలుస్తాను. సీ యూ దెన్, బాయ్.